Welcome, welcome, welcome. Welcome to the Nest Egg Show. My name is Jonna Hudson, and today we have with us Nate Hare. Nate is the executive director of Direct IRA. He is a 10 plus year veteran in the self-directed IRA industry, spending most of his career as an executive educator, educator, and public speaker. Nate is a CISP, a certified IRA services professional, a licensed loan officer, and has extensive experience in real estate and business development. As an investor, private lender, and SDIRA executive, Nate has personally overseen thousands of self-directed IRA investments involving real estate, promissory notes, and more. Nate is an expert on self-direction and has been a contributor to U.S. News and World Report, Fox Morning News, and has helped educate tens of thousands of individual investors on how to use self-directed IRAs, 401ks, and other plans properly. He's been a major contributor to the growth of two self-directed IRA companies, including Directed IRA, the fastest growing self-directed IRA company in the country, named in the Inc. 1000 list for fastest growing companies in the USA for 2023, with over 700 five-star reviews. He is a 10 plus year veteran in the self-directed IRA business. Nate holds a business management and finance degree from the University of Portland and was named one of the top 100 people in finance by Top 100 magazines in 2019. Thank you for joining us, Nate, and take it away.
Of course. Well, thank you for that introduction. I appreciate that. Every time someone brings up my college degree, God, I feel like that's a whole nother lifetime ago. So much has happened since then. But I'm thankful to be with you guys today. And what I'm going to be sharing with you guys is just a little bit of education about self-directed IRAs and why they're important to me and the 20,000 clients that we serve who want to use their retirement funds, whether it's an IRA, a 401k, a Roth IRA, and invest in things that are not tied to Wall Street, invest in things that are more tied to Main Street, things like rental properties, syndications, apartments, all types of commercial investments. Most people don't even realize you can use your IRA to invest in those things because they're constantly sold investments by their stockbrokers and their wealth advisors. So I'm going to share with you guys a little bit about retirement accounts in general and give you some examples of the types of investments our clients are doing here at Directed IRA that are invested into what we call alternative investments. And most of those alternative investments are real estate based. So I will say, as a real estate investor since 2004, I learned about this a lot later than I wish I would have learned about this. Nobody ever told me or taught me about the power of owning real estate inside of a retirement plan. In fact, I was talked out of it, not knowing much about tax savings and IRAs specifically. The more I learned about how IRAs and 401ks work, the more I saw that story that was pitched to me was false. The story that was told to me that I shouldn't invest in real estate in an IRA because you don't get things like depreciation is just a moot point. So I'm going to show you guys kind of what some of the things that our clients are doing with their retirement plans and really making life-changing decisions by investing in things that they know and understand better. So I'm going to go ahead and share my screen here, and I'm going to try to have some time at the end, obviously, to take some questions. And if we don't have quite enough time, that's okay. I'll give you guys my email and way to contact me if you guys want to. So just let me know if you guys can see this. Is that showing up okay?
It is.
Okay, awesome. All right, so let's just jump right underway. And this is kind of the tip of the iceberg. I'm going to talk a little bit about what self-direction is, how it's different than maybe an IRA or 401k that you're accustomed to using, the types of plans that you can use to invest in real estate and truly escape taxation for the rest of your life and future generations beyond your life, and how it kind of works. What types of strategies are investors using in these self-directed plans when it comes to real estate? The most important thing we want to touch on, though, is just the fact that retirement plans hold most of Americans' dollars. More people have money in their retirement plan than their bank account. Yet most people, if you ask them what investments do they own in their 401k or their IRA, most people have no clue. They might know the name of the mutual fund, but they don't know the companies in the mutual fund. A lot of people don't even know where their IRAs or 401ks are at. You guys have probably seen those commercials. Locate your 401k if you have a lost 401k. It's funny that we take so little attention or take so little attention to our retirement accounts when there's $45 trillion in them. And most Americans just invest in the things that they're told to invest in, which are stocks, bonds, mutual funds, ETFs, and what we call traditional investments. So if you're thinking of investing, think about, well, where is most of my money? Do I have money in my bank account or do I have money in my retirement account? And most people say they have more money in their retirement account, but they didn't realize that they had more investment options available to them. So just a little history lesson. IRAs were created in the mid 70s. Ever since they were created, and when I talk about IRAs, I'm talking about traditional IRAs. Roth IRAs came out a little bit later in the late 80s, SEP-IRAs and things of that nature. IRAs have always been able to own the same investments. Okay? And you probably didn't realize that the investment opportunities or the investment options of what you can hold inside of a retirement plan go well outside the traditional investments. There's a whole spectrum of investments in the alternative space. Now, it's funny when we say alternative, because for me, real estate was always the most traditional investment. It's the American dream, right? But in the retirement world, they pitch it as an alternative investment. It's kind of funny how they named that an alternative because they steer you to investing in the traditional investments, which are all the things tied to Wall Street. And by no means am I saying stocks are bad. My stock portfolio is doing pretty well right now. I'm happy with it. But for me, ever since 2004, I've always been working and around real estate and real estate investors. I was a licensed loan officer back in 2004. I still hold my license today, even though I don't practice. I've had 20 rental properties at one time. I mainly do private lending to real estate investors. I'm a hard money lender personally with my retirement funds. So my knowledge base is real estate. I know much more about real estate than I do the stock market. So for me, when I learned that my IRAs and my 401ks and all the plans that I had set up that owned stocks and bonds and mutual funds could actually own the things that I was more knowledgeable about, in 2012, I made a career shift and got full steam into this because I felt I wish I would have known about this 10 years prior to learning it. And nobody around me even knew this was an option. So I thought, more people need to understand that this is at least available to you out there and that you can own anything inside a retirement plan according to the tax law, except two investments. There's only two things you can't own in a retirement plan: life insurance contracts and collectibles. That's it. Those are the only two things the IRS says we don't want those in a retirement plan. So have you never heard of this option of owning a rental property in a retirement plan, or a note secured by real estate in a retirement plan, or land in a retirement plan? I'm taking direct ownership of land. We're not talking about owning a piece of a REIT. We're talking about direct ownership of real estate by your retirement plan, because most people have an IRA at Fidelity or Charles Schwab. Doesn't mean they're not bad companies, but the nature of their business is to sell financial products. They make commissions by selling you those investments that you see on the left there. Okay? So they're never going to allow you to invest in the things that don't make them money. It doesn't mean you can't hold those things. You just can't hold real estate in an IRA with Fidelity. You have to find a company like Directed IRA, which is us, that will hold alternative investments on your behalf. Now, this is where the self in self-direction comes from. You see, the difference between Fidelity and directed IRA is, first, we're both similar because we're IRA custodians. They're licensed to hold assets. We're licensed to hold assets. We're both custody. We're both the custody or the custodian of your retirement assets. The difference is they sell investments. We don't. Our account agreement with our client says we'll hold anything in your IRA that the IRS allows. But you have to tell us what that investment is. You have to find it, and we'll buy it in the name of your IRA. And there's a little bit different of a process when we're buying real estate with your IRA versus just buying a stock. And I'll talk a little bit about that process. But here are some of the common investments that we hold here at Directed IRA in our clients' retirement plans. Real estate. Now, real estate's pretty general. That can be a fix and flip. That can be a rental property. That can be land. It can be partnerships in a syndication that own multifamily or commercial property, tax lien certificates, promissory notes, which is what I like to hold in my retirement plan. I'll talk about why I like to own promissory notes inside of my retirement plans. And you can even do creative real estate strategies inside of a retirement plan. And by creative, I mean your IRA can leverage bank financing to help it buy more real estate. Okay, again, these were new concepts to me. And the more I learned about this, the more I went down the rabbit hole. And now it's all I do all day is teach people how they can leverage their retirement plans to own things like real estate. So first, why would you want to own real estate inside of a retirement plan? Well, if you think about just how the fundamental difference between a rental property or a piece of property and a stock, piece of property, whether it's land or the box on top of the land, is tangible. The stock to me is not tangible. Because if I invest in a stock and that company that stock's with goes belly up or goes bankrupt, I don't have anything. I lose everything if I invest in the wrong companies. If I invest in a piece of property, okay, that's a tangible asset. I can drive by it, I can touch it, I can feel it. It's got an address, it's got a parcel number. I know exactly where it's at. That asset could burn to the ground, but I have insurance that'll cover the loss on that because insurance companies insure tangible assets. So at the end of the day, if I'm thinking I want more safety and security inside my retirement plan, doesn't it make sense to hold some assets that are tangible versus just holding a bunch of paper that can fly away in the wind? Most of our clients have accounts at Fidelity and Directed IRA because they want to be able to hold tangible assets, but they also feel that that's a better way to get true diversification if you're trying to diversify your retirement portfolio. Wealth advisors will tell you what diversification is: owning some high risk mutual funds, some medium risk mutual funds, and some low risk mutual funds. I would say that's still all your eggs in one basket because all of those investments are still tied to one thing, and that's Wall Street. Okay? So even if you're not a real estate expert, I think there's a lot of advantages to holding things like fee simple real estate that is tangible, and the fact that it gives you a little bit more diversification. And if you want to go even deeper, real estate's the largest segment of our economy. I would probably say if you don't own some type of real estate investment inside your portfolio, again, you're missing the boat on something that's going to be around, forever. That's always, has the ability to generate income, which is real estate. Here's where the magic happens when we talk about IRAs, 401ks, and other types of tax exempt plans and real estate together. You see, your IRA can own stocks, bonds, and real estate. The benefit to owning real estate in an IRA is an IRA is not a taxpayer. Okay? By definition, your IRA or even your 401k is a tax exempt trust. It's an entity by itself. You're just the fiduciary of that plan. Your job to that plan is to put money in it as a contribution, to invest it. And the IRS says the trade-off is if you invest this and you don't take money out until 59 and a half or whenever you have qualified distributions, we won't tax that account on any of the investment growth. So think about that for a second. If I own a rental property inside a Roth IRA, for example, and we'll talk about the accounts here in a second, but if I own a rental property and it's owned by my Roth IRA, all of the rental income that come into my Roth IRA, tax-free. All of the gains on all the sales of my properties inside my Roth IRA, tax-free. No capital gains tax ever owed by an IRA because it's not a taxpayer. So if you think about that, your money grows much, much faster inside of an IRA versus just investing in real estate personally, because I pay a lot of taxes if I'm buying and selling real estate outside of an IRA. I'm not saying that buying real estate outside of an IRA is bad, but buying real estate inside an IRA has massive tax benefits if you could do it right. And here's the other cool thing, which we'll talk about here in a second. You don't need hundreds of thousands of dollars in your IRA to buy real estate. You can use all sorts of creative strategies and leverage points to take small amounts of money out of your IRA and either control or invest in real estate and leverage other buckets of money, be it bank financing or whatnot. So we'll talk about that here in a second. But truthfully, when you have an IRA, that allows you to invest in alternative investments, what it really does is it puts the keys in your hand. You're ultimately the decision maker, and you get to tell us what you want to invest in. And we're not going to limit you to just stocks, bonds, and mutual funds. We allow you to invest in all sorts of things. A lot of clients that have cryptocurrency in their IRA, not a crypto ETF. I'm talking about they own Bitcoin in a Roth IRA. They own Ethereum in their Roth IRA, and they do that through a company like us because that's the service that we provide. But let's stick to real estate. But first, I want to talk about the plans that we have here at Directed IRA that can own real estate. Okay, there's three categories of plans. Now, remember, as I mentioned, these are all tax exempt trusts. Every one of these plans pays no taxes on the gains. Now, some people might say, well, Nate, I pay a lot of taxes when I take money out. Yes, as a distribution to you, you're a taxpayer. You pay taxes when you take money out on certain plans. And that is usually your pre-tax plans, meaning traditional IRA, most SEPs, most 401ks. But again, the IRA itself does not pay taxes. Even a traditional IRA doesn't pay taxes. If I own if I do a fix and flip or buy a house and flip it, right, but it's owned in my traditional IRA can make $100,000 gain on that investment, and I can reinvest all 100 grand, no taxes, right? There's no tax return that your traditional IRA has to file. You may pay taxes at the end of the road when you take money out, but there's different ways that you can minimize this tax. And a lot of times minimizing the tax means pay the taxes before you make the investment. Now, the difference between a traditional IRA and a Roth IRA, this is where real estate becomes real powerful. Okay. Personal plans can both be self-directed. They can both own real estate. In my mind, I go with a Roth IRA all day, every day. And here's why. Roth IRAs work the polar opposite as a traditional IRA. Think about a traditional IRA, you put money in as a contribution. You typically write that contribution off on your taxes. You get a tax deduction that year, but it just defers the tax to the future. So in a sense, let's say you've put $100,000 in as contributions to your traditional, then you grow that traditional IRA to $1 million through your investing. Good job. You got to pay taxes on $1 million now. Okay. If you're going to invest and you know you can grow a bucket of money, in my mind, mathematically, it makes more sense to pay the taxes before I grow the account. If I'm going to put $100,000 in a retirement plan and I can grow it to $1 million through my real estate or through whatever investments I make, I would rather pay the taxes on $100,000 versus pay taxes on $1 million. Most people don't have that forward-thinking approach. And truthfully, CPAs always talk us out of Roth IRAs because they always try to get us to take the tax deductions up front with the theory that you're going to pay less in taxes when you're retired. I'm not going to pay less in taxes when I'm retired if I grow it from $100,000 to $1 million. Doesn't matter what tax bracket I'm in. $1 million tax is going to be more than anything that I have to pay on $100,000. I'll give you an example of how this Roth IRA becomes even more powerful if you set one up and start stacking assets in it early. Roth IRAs, the way that they work is once you've had a Roth IRA for 5 years and you're above the age of 59 and a half, you have now what's called qualified distributions out of your Roth IRA. Qualified distributions are tax-free and penalty-free for the rest of your life. Never have to pay a dime in taxes on any money you take out. So let me give you an example of a real client that I have. He has 12 rental properties that are owned by his self-directed Roth IRA. Okay, these are all scattered through Texas. Most of them are in Houston. Okay. Each month, these tenants of these 12 rental properties do not pay rent to him. They don't pay rent to his LLC. They pay rent to Directed IRA. That's us. Okay. It's deposited as profit to his Roth IRA. If you went on the county assessor's page, you would see Directed Trust Company, FBO, his Roth IRA as the owner of all these properties. Okay. When the renters pay rent, it goes to the Roth IRA as income to the Roth IRA. And now that he's 59 and a half and he's had the Roth for 5 years, he just takes a distribution every single month from the Roth and never has to pay taxes on those distributions because he has qualified distributions. So every single month when these rents come into his Roth IRA, he takes a $25,000 distribution to himself. Month one, month two, he takes another $25,000 distribution, another 25. So he's taking almost $300,000 of tax-free distributions from his Roth IRA owned real estate that are generating rental income. Now, meanwhile, his account balance grows every single year. How's his account balance grow if he's taking so much money out? He's only living off the rents, the rental income that the Roth IRA is generating. He's not touching the principal of the assets, which is the equity and the appreciation on the property. So as his properties appreciate, his account balance goes up and he just lives tax-free off the rents. The IRS can't touch him. He's off the grid. Here's the other beautiful part about the Roth IRA. When you own assets like that and you die, those assets don't disappear. Those assets just move to your beneficiaries as an inherited Roth IRA. And inherited Roth IRAs grow tax-free for another 10 years. So those same 12 rental properties, when he dies, the legacy he's going to leave his kids is an inherited Roth IRA to the kids with the same properties in it, with the same tenants in it, paying rent to an inherited Roth IRA now, and they get to take tax-free distributions for another 10 years. That's multi-generational wealth, and he paid the taxes way early in the game on his contributions to the Roth IRA. So that's why you almost get the sense that Roth IRAs are the only accounts that can be self-directed because people talk about them so much. I just think they're powerful if you can take a small amount of money and grow it larger. Now, the other accounts you could self-direct, and I don't have time to go over them today. I've got special classes on them if you're interested. But we've got employer plans that can be self-directed, which are the SEP-IRA and the solo 401k. And we also have non-retirement plans that can be self-directed and own things like real estate. Health savings accounts can be self-directed, and educational savings accounts for your kids or your grandkids can be self-directed. Think about it like this. It's a 529 plan that can invest in real estate. Okay? Powerful, powerful stuff. So not only can these plans help you save and grow income tax-free for your retirement, but if you use the accounts right, you can actually self-direct plans that let you take the money out today without waiting and pay for health expenses with tax-free dollars and education expenses for your kids, your grandkids with tax-free dollars as well. So I kind of mentioned this, right? If you think about the asset and how real estate works, right? Where you've got appreciating assets, you've got cash flow. Even if you're the passive participant in a real estate investment, you may have interest income from borrowers, you may have dividends from or distributions from syndications, right? If you're going to use an IRA, think about how you want to use the money. Think about how, because that's how you get your benefit from the IRAs through the distributions. And I kind of mentioned it. My favorite are Roth IRAs, HSAs, and ESAs. Why? Because if you plan it out right, as you invest those accounts, you don't have to pay any taxes on the income or the distributions that you take from those accounts. Okay, so let's talk a little bit about the types of real estate that you can invest in. So as I kind of mentioned, really any strategy fits the box of a retirement plan. Okay, whether that's you want to buy and hold, you want to fix and flip, you want to be more passive with your IRA, you even want to do some creative stuff like wholesaling, flipping contracts, signing contracts. You can do that inside of an IRA. Real estate options and joint ventures. Again, these are all creative strategies that can be done inside of an IRA. But here's how the process works. Okay? If you want to invest in real estate, it's really a three-step process. Okay, first, you've got to open an account that can be self-directed. Now we've got accounts online. If you want to go to our website, it's directedIRA.com. I have the web address here at the end here, but directedIRA.com. You just go to the website. You fill out the application of the IRA that you want to open, whether that's a traditional IRA, a Roth IRA, or any of the other accounts that I mentioned. Once you have that account open, typically what you want to do is you want to fund the account. You can fund the account either by just making a contribution to it. You can transfer money from an existing IRA, or if you've got an old 401k or an old 403b or old TRS plan, TSP, that can be rolled into your self-directed IRA here at Directed IRA. So open it and fund it, pretty self-explanatory. And we help you along the way on that. When it comes to the investment, that's where it changes a little bit. You're not logging in online and pressing buy like you would Fidelity or Charles Schwab. What you're typically doing, if it's real estate, is you're going out and you're finding the real estate. And there's active real estate investments and more passive real estate investments. We'll talk about both. I've got an active case study and a passive case study just to give you an idea. But basically, what we're not doing is we're not giving you a distribution out of your IRA to go run and buy real estate. That's not what you want. What we need to do to make sure you get your tax benefits to the IRA, we have to exchange your IRA's asset of cash for an asset of real estate. Just like Fidelity exchanges assets of cash for assets of stock, we're going to exchange assets of cash for assets of real estate. Now, how do we do that? Let's imagine that you're going to buy a property and you want it owned by your Roth IRA. Okay. You're going to negotiate your terms with the seller. You're going to find the property. All the legwork is still the same with you identifying the investment. What changes is the buyer on the contract is not you. The buyer on the contract is not your LLC. The buyer on the contract is your IRA. And your IRA, as I mentioned, it's a separate entity on its own. It has its own name. If you have a Roth IRA here at Directed IRA, the name for that account is Directed Trust Company for the benefit of your name IRA account type. That's it. So as you're sitting there with the seller, you're going to tell them, I'm going to have this bought by my IRA. My IRA custodian is going to sign the contract. That's why you see the buyer here is Directed Trust Company FBO my account. Okay. So that's how you start the transaction because we're going to buy it in the name of the IRA. We're not going to give you a distribution. We're going to exchange your asset of cash for an asset of real estate. So it starts with the contract. Now, very important, we have to sign the contract as your custodian. Now, we're not going to approve or disapprove your investment. We're just going to take your instructions to buy this investment that you found. We're going to buy it in the name of your IRA. So once we get the contract and we see that the name's right, we sign the contract as your custodian. We send that back to the agent or wherever we need to send it. And then based on the terms of that contract, if there's earnest money, we're going to send the earnest money directly from your Roth IRA or your account here directly to the title company. Okay. We've never given the money to you. It's not a distribution to you. And when we get to closing at the end of the road, we're going to send the funds to close, whether that's funds for the down payment or funds to buy it cash directly from your IRA to the title company or attorney's office. When we're done, the title company is going to send the deed to us, and that's what we hold as evidence of your investment. Just like Fidelity holds the stock certificate, we hold the deed. It's just a different document. It's just a different evidence of ownership. Now, there's different documents on what you would use depending on what you're doing. But if we're talking about real estate, ultimately what we're going to do is hold the deed. So let me give you an example of a friend of mine, Randy. Again, he's in Houston as well. I have a lot of Houston case studies because I worked for a company there for 9 years. So this is a buddy of mine, Randy. He's a commercial real estate broker in Houston. This was his first deal that he did in his Roth solo 401k. Now he's self-employed, no employees. So the solo 401k was the best option for him. I'm just kind of feeding you guys a little bit of information. If you're self-employed, make sure to reach out to me because I'll probably talk to you about a solo 401k over an IRA. But he had a whopping $6,000 in his Roth solo 401k. Okay. Now, what he did is as he was out looking for properties in North Houston, he found a property that was recently taken over by the widow. Now, this was 3 warehouses. The 3 warehouses were typically managed by the husband. The husband unfortunately passed away. And when he passed away, the 3 tenants started taking advantage of the widow's kindness. And she was a little frustrated having to deal with these properties. Now, the thing with her is she didn't need the cash, even though they own these free and clear, but she did kind of like the income that was being generated when the tenants were paying. But as soon as the husband died, they kind of stopped paying. So my friend Randy had a conversation with her. After finding out what she really wanted out of this deal, he made an offer to her and he said, well, look, you own these properties free and clear. You want the monthly payments, but you don't want to deal with the tenants. What if I could give you the payments? I'll make payments to you and I'll deal with the tenants. If I can strike up a good deal on that, would that be something that you'd be interested in? And she said, yes, that would be something of interest to me. So what he did is he drew up a contract or negotiated terms where his Roth 401k was going to give the $6,000 it had as a contribution to her as a down payment. And the Roth 401k was going to carry back the note. Again, Randy's doing the same legwork. The only difference is the buyer on the contract is his 401k. The borrower on the note is his 401k. Okay. So the $6,000 goes out as an investment. Now the Roth 401k owns 3 warehouses in Houston with a note to the widow. 16 months goes by, and basically what happens from this point on is the tenants of those 3 warehouses now pay rent to the 401k, the new owner. Randy puts his property manager in place, kicks out one tenant that stopped paying altogether, gets a new tenant in there almost immediately, gets the other tenant in warehouse 2 to start paying on time every single month. And the tenant in warehouse 3 was always paying on time. So within about a week and a half, these 3 warehouses were fully rented, okay, or fully leased. All the lease payments now are going to the Roth 401k as the new owner. Randy is simply taking those payments out of the 401k and paying the widow on the agreed note payment. This goes on for 16 months until the tenant in warehouse 3 makes an offer to Ryan and says, I want to buy my warehouse and own it outright. I just had a baby. I'm going to stay in Houston for a while, and I'd like to own this warehouse. They say, okay, great. My Roth 401k, which is the owner, will sell off one of these warehouses to the tenant. And the money that was made off of that sale that goes to the IRA or the 401k, which is not taxed, was enough to pay off the existing note to the widow, which then left 2 cash flowing leased warehouses worth about $100,000 each owned in his tax-free Roth 401k. He did this investment with $6,000, and he did this first investment at the age of 32. He took a $6,000 investment and turned it into $200,000 through his knowledge of real estate and his creative negotiating, right? To leverage seller financing to have his IRA/401k as the owner. So that's where the term self-directed comes from. He did all the same legwork. It was just the 401k was the buyer, 401k was the borrower, the 401k collected the rent payments, the 401k paid on the note, the 401k gets all of the income from the sale, and he keeps investing this. And he's actually sold these warehouses. Now he owns a small multifamily in Houston. Again, that's all generating tax-free dollars to him that will be completely tax-free once he's 59 and a half. So let's talk a little bit about more of the passive side too. And I kind of mentioned I like to do note investing. Now, this is one of the most popular investments that you can do in a self-directed plan. Most people who have self-directed plans are not like my friend Randy. We have a lot of clients that are full-time real estate investors or real estate brokers, right? They're out there finding their own deals. Most people just don't have access to deals, or they still work 9-to-5 jobs. My 9-to-5 job, you're watching it right now. I'm an executive at Directed IRA. Even though I like and love real estate, I don't have time to go find deals on my own. So what I do is I leverage the work and the experience of other real estate investors in my community. And what I do is I use my IRAs as a lender. I just do hard money lending straight out of my Roth IRA, straight out of my HSA. Now, for those of you who are interested in lending, I will tell you there is a massive pendulum shift to the tax benefits an IRA gives you when you're a lender, because there is absolutely no benefit for lending your own money. There's no tax advantage to lending your own money unless you have a lending company. But if I'm going to loan $100,000 of my own money to a friend who's buying real estate, I have to pay interest. I have to pay taxes on all of that interest income. There's no write-off for me. But interest income to an IRA is completely tax-free or tax exempt. So typically when I do loans in a specific way. I like to do loans out of my IRA on short-term deals, 6 to 18-month loans to real estate flippers, okay, who are flipping property. And there's a reason why I like to do short-term loans and not long-term loans. And most of the times I'm just doing simple interest notes. Now, how it works in an IRA is you're going to have a different document. It's not going to be a deed. We're going to have a promissory note. So if an investor approaches me and says, hey, Nate, I've got a great deal. I'm looking for some private financing. Would you be interested in having your IRAs be the lender? I'll look at the deal. If I like the deal, what we'll do is we'll have a promissory note drafted by one of our attorneys. There's going to be a lender, there's going to be a borrower, there's going to be a principal balance of the note, there's going to be an interest rate, there's going to be points, right? But the lender on the note is going to read my IRAs, okay? And I'll skip forward here. I normally will always include my Roth IRA and my self-directed health savings account. Again, it's a tax-advantaged account that I can use to self-direct. When the note's drafted, both of my accounts are going to be listed as the lender. Now, this does not make it 2 notes. This does not make it 2 liens. This is just a fractionalized note, right? There's still one check coming from Directed Trust Company. If we go back here, this is a typical deal that I'll do, $100,000 loan to a real estate flipper. 75,000 of that will come from my Roth IRA. 25,000 of it will come from my HSA, but it's still one wire to the title company for $100,000. Okay. The note's just going to be owned fractionalized by my two accounts, which means when the borrower makes interest payments on this note, that interest payment is split pro rata, meaning 75% of the interest goes right to my Roth IRA tax-free. The other 25% of that interest payment goes to my HSA. Now, here's the cool thing with the self-directed HSA. I don't have to wait to take that money out. I can immediately take that interest income out tax-free to buy glasses or go to the dentist or buy prescriptions or pay for my copays. Because in HSA, I don't have to wait, right? But it's still tax-free dollars to me. So I always try to incorporate both accounts because they work differently on how I can take the distributions. Now, it's pretty easy nowadays to get, I would say, 2 points and 12%. So I'm making 14% return by just lending my money out. And all that 14% that comes back is completely tax-free. It's a paper investment, but to me, it's much better than a stock because that paper is secured by real property. So in the event my borrower dies, I have rights to the property through foreclosure. Okay, not that I want the property, but I can sleep at night knowing that my money is secured by something tangible. I know exactly where it's at. And what directed IRA will hold as evidence of my investment is the promissory note. And if we're working in Texas or a state, they'll hold the deed of trust. So though that's the evidence of my investment here at Directed IRA, and I love the fact that I get tax-free, penalty-free interest income from borrowers through their sweat equity. Now, if you want to know if lending works, I don't know, you tell me. If I'm lending my money out and I'm getting my principal and interest back within about 12 months, here's the other cool thing with these IRAs is now I can compound my interest. Now I can just reinvest my interest every single year. That's why I like to do short-term notes because I want to compound my interest. And if I start with $100,000 and just keep my money invested and compounded in a Roth IRA, for example, tax-free, $100,000 turns into $1.4 million without me putting a single penny additional in contributions, all through interest income or note payments from the borrowers buying real estate. And the beautiful part about me, I know what those real estate investors are doing with my money. They're buying eyesores in the neighborhood. They're taking ugly homes and making them pretty. They're putting contractors to work who are putting subcontractors to work. I like the look and feel of that investment versus like some nameless overseas mutual fund that I have no emotional attachment to. This is why I like to invest in my local people and my local community through real estate. So that's just a kind of a tip of the iceberg of how these self-directed plans work. Again, if you want to invest in alternatives, you still have to work through a custodian. We are the custodian that handles alternative assets or alternative investments. And here's the cool thing with IRAs and 401ks. You can have as many of them as you want. I have a client that has 45 IRAs scattered all across different companies because he wants the ability to invest in different things. So by no means you have to close down your IRAs or your 401ks. You can have multiple, but the ability to own real estate and invest in things that you're more knowledgeable about will probably get you to retirement much, much faster than just investing in the things that you think you have to invest in. So if you guys have questions, there's my email. Feel free to shoot me an email, nate.hare@directedira.com. If you want to book a call with me, you can just scan that QR code. I've got a team of IRA executives on that same page. So if you want to book a call with one of them, and if you guys do decide to open an account, just use that code. Nate150 allows me to track you guys back to this and know you guys watched, and we give you $150 off your first year's annual fee if you use that discount code as well. So that's all I got. I guess I can take questions if we got any
Yeah,
questions.
thank you, Nate. We do have one question in the chat before I open it up to live questions. So Tina asks, can a Roth benefit from depreciation expense?
No, and here's why. What do you use depreciation for? To offset tax. What tax are you offsetting in the IRA if it pays no tax? You don't need it. And this is a common misconception. And this is what I was told by CPAs that didn't understand real estate. They would say, why would you buy real estate in an IRA when you don't get depreciation? Like, that's not the point of investing in IRA. The point of investing in IRA is I want to invest in the thing that gives me the most return. So if I don't get depreciation, does that mean I should just buy stocks because I don't get depreciation? So I just invest in something I know less about and make less money on? Or should I just invest in the things that I'm more knowledgeable about? Outside of an IRA, it's different because you need depreciation because you're a taxpayer. So you're constantly trying to offset the taxes that you have to pay on the income that you're generating. In an IRA, it doesn't pay any taxes, so you can't use depreciate. There's nothing to depreciate against. Now, I will tell you, there are certain circumstances where you can use depreciation in an IRA if you turn your IRA into a taxpayer. I'll give you an example. Let's say my Roth IRA wants to buy a property and it just wants to put a down payment down. Let's say $30,000 down payment on a $100,000 house. My IRA is going to borrow $70,000 from a bank. That $70,000 that's non-IRA money, that money is taxable to my IRA. Now I can use depreciation to offset that tax. But again, most of the times, if you're just buying investments all cash, there's nothing to depreciate against. So it's kind of a moot point.
Okay, we have another question, and I'm not. I think I know what he means, but I'll ask a question because I had the same question, and if that's not it, we'll get some um, clarification. Can I invest in a self-directed IRA, and let's say it's a value add, and when they're doing the renovations and the NOI falls, can I convert to Roth?
Yes. So that's a good strategy. So there are certain investments, and this really comes into if you've got money tied up in a traditional IRA. Remember, your traditional IRAs, you're going to pay taxes on the distributions that you take out. Now, ever since 2010, anybody can do what's called a Roth conversion, meaning I can pay the taxes on some or all of my traditional IRA just to get it to a Roth IRA. So from taking it from after tax to pre-tax. There are strategies that make the decision a lot easier as to when you want to do a conversion. For example, I buy an investment at $100,000, it drops in value, or I can get it valued at $70,000, even though it's still a $100,000 investment. What I'm going to do is I'm going to buy it in my traditional IRA for 100. I'm going to get it revalued at 70, and then I convert that asset at $70,000 to a Roth IRA and essentially get a 30% tax break on a conversion. So it's still an asset of $100,000 moving over, but I'm just revaluing it at a lower point. Now, you can't do that with every investment, but certain investments based on how they work, you can have an outside third-party appraiser appraise it for a lesser value. And then what you do is you give that appraisal to your custodian like us. We do a conversion at that new amount. And then all the profit beyond that point, all is tax-free, but now in a Roth IRA.
And that has to be done through appraisal, or can it be done through the NOI? So I get a basis statement on one of my accounts that tells me that my basis has fallen, right? Because the valuation has fallen. Is that enough?
We'd have to see it. There has to be some sort of concrete, substantial valuation because what's happening is you're telling us what the value of it is, and since it's a reporting, it's going to be reported to the IRS. We need to make sure we have some clear documentation that it's X value. Usually, we need an outside third party to value it. For example, if you own real estate, you can't just give us like a tax appraisal or just some document that somebody came up with. It's got to be a legit appraisal. They also do these with mineral rights, for example. Mineral rights is one of the investments that people do this a lot with. All the oil and gas guys, and all the big wigs there have already figured this out. Is if they buy a bunch of wells for X amount, they can get the wells valued at this amount because of the risk of that investment. They convert, and then the wells hit, and everything's completely tax free. So the fact that we have to have some sort of concrete value, we're probably going to ask for something a little bit more concrete, usually through a third party.
Okay. So you can come off mute if you want and ask a question directly. Let's see if there's anything else in the chat. Code link. So Jay asked code link. I don't know if she wants you to put that screen back up.
Oh, yeah, let me
Jay, is that what you want?
is that Sean?
Yeah, thank you very much. I appreciate it. I missed it.
Yep, just my name 150.
Okay.
Nate, this is Eugene. I've got a question.
Yeah.
I've had a self-directed, well, self-directed IRA for close to 20 years. My challenge when I had mine was with the equity trust. I'm about to put my kids into some IRAs. Challenge I always had with equity trust was speed of execution. How well do
Mhm.
you guys do on speed of execution? I was a lender just like you, and I went to a checkbook IRA because they were just so damn slow.
Yeah, yeah. So I don't like knocking on competitors because they are the biggest company in the industry, but when you're the biggest company doesn't always mean you're the best company. And the problem with some companies, and I won't point them specifically, but some of these companies, when you talk to somebody, you got to talk to six people. I'm sure you know exactly what I'm talking about. You got to talk to six people before you even get an answer that you like. For us, if you go and look at our reviews, just go to a Google and actually read the reviews from our clients. I think we just eclipsed 900 five-star reviews. And we've got the highest rating for customer service in the entire industry, 4.9 something. I can't remember. But that all comes to the fact that we get investments funded and deployed. 24 to 48 hours is our typical turnaround time. Every once in a while, if things aren't correct, it might take 3 business days, which I think in our industry is still rocket fast. I have clients every day coming over from Equity Trust saying that they take 2 weeks and they can't get answers from anybody on the phone. We don't operate like that. Myself and the principals here, we're investors by nature. I was an investor before even getting into this industry, so I understand how important it is to get deals funded. So our typical turnaround time is 24 to 48 hours, if I'm answering your question there. And we also make the process really easy. Most everything is electronically signed. We have a dedicated investment team, and they specialize in mostly real estate. Real estate lending syndications is what we fund the most of.
Right. Thank you.
Any more questions? Let me check the chat. Okay, if there's no more questions, Nate, if you'll just hold on, I'll for one moment.